Wall Street just made a big announcement. The dreaded 2025 recession has been called off. But is this really the end of the storm, or just a break before the next shockwave? A new trade deal with China has brought some relief to the markets, but risks like tariffs, inflation, and public debt are still looming. In this video, you'll get a behind-the-scenes look at what's really happening in the global economy and learn how to protect and grow your money. If you're into this topic, hit the like button, share it with someone who needs to see it, and subscribe to the channel. The announcement: recession called off. The financial markets breathed a sigh of relief. Wall Street analysts say the previously expected 2025 recession is officially off the table. What sparked this turnaround? A preliminary trade agreement between the U.S. and China eased geopolitical tensions and reignited investor optimism. This progress in negotiations points to a possible rebalancing of global trade, which boosts confidence across the corporate world. Stock exchanges in New York, London, and Frankfurt responded positively, with major conglomerates seeing gains after months of pressure. Investors took the deal as a signal that the global economy might keep growing, at least in the short term. Multinational companies even started revising their expansion plans, showing a renewed appetite for risk. But hold on, this doesn't mean everything's fine. Analysts warn that the excitement could be short-lived if structural uncertainties aren't addressed. Markets tend to overreact, both positively and negatively. Key point of concern: unresolved tariffs. A final decision on whether new tariffs will be imposed or suspended is expected on July 8th. This date could be a turning point for global trade and operational costs across key U.S. industries. Potential damage if tariffs return. Sectors like tech, manufacturing, and retail could take a major hit, undoing current optimism in a matter of weeks. Moody's downgrades U.S. credit rating. The agency cited unsustainable public debt levels, making it more expensive for the government to borrow, affecting the entire credit system. Higher interest rates increase pressure. Consumers, businesses, and local governments all feel the strain, which hurts public investment and complicates debt refinancing. Federal Reserve warning. The Fed has made it clear that inflation remains a real threat, and there's no guarantee interest rate cuts are coming anytime soon. Why the Fed is cautious. Cutting rates too early could reignite inflation and force even higher rates down the line, something that could severely harm the economy. The takeaway? Despite the good news, the situation remains extremely volatile. And as we'll see next, the 2025 recession fears weren't random. They had very real foundations. Why a recession was expected. To understand why analysts were predicting a recession, we need to go back to the beginning. The tariffs announced by former President Trump earlier this year. That move disrupted economic balance and triggered a chain reaction in the markets. Tariffs directly increased the cost of imported goods, making them more expensive for consumers. But the impact goes further. Companies that rely on these imports also suffer, with higher production costs and tighter profit margins. The trigger: in January 2025, Trump announced a return of tariffs on a wide range of imports, especially from Asia. The goal was to boost domestic production, but the markets immediately reacted negatively. Tech, retail, and auto companies saw their stock prices tumble. Why? Rising production costs and fears of a U.S.-led global slowdown. Key data: a technical recession happens when the economy contracts for 2 consecutive quarters. This is the benchmark used by institutions like the NBR to define U.S. recessions. The U.S. already posted a 0.7% drop in GDP in Q1 of 2025, and projections for Q2 suggested another decline, meeting the criteria for a formal recession if confirmed. Historically, the U.S. has gone through 16 recessions in the last 100 years, averaging more than one per decade. Economic downturns are normal and should be met with preparation, not panic. The stock market also saw 25 crashes of over 20% in that same time frame. Extreme volatility is part of any long-term investor's journey. In short, the recession warnings weren't fear-mongering. They followed historical patterns. What changed investor sentiment was a shift in the geopolitical and economic landscape, which we'll explore now. 4 key factors to watch in 2025. Despite the current relief, there are 4 key elements that could quickly flip the script. Anyone looking to protect their investments and make smart moves needs to keep a close eye on these. Key 1. Trade tariffs. The game isn't over. Even with the preliminary deal with China, there's still no final word on the tariffs plan for July. The critical date is July 8th, when the current pause is set to expire. If tariffs are reinstated, the cost will hit companies and ultimately consumers hard. This could disrupt entire supply chains, especially in industries that rely heavily on imports. Real-world example. The auto industry has warned that new tariffs could add up to $1,200 per vehicle. That impacts dealership prices and could contribute to overall inflation. Plus, tariffs often lead to retaliation. Affected countries may respond with their own barriers, potentially igniting a new global trade war. Key 2. Inflation. The fight isn't over. While official data shows inflation is cooling, the threat hasn't gone away. The cost pressures from potential tariffs could spark a fresh wave of price hikes. Inflation is one of the biggest concerns for central banks because it erodes people's purchasing power. When prices rise faster than wages, the population feels poorer. Walmart, for instance, has already increased prices across dozens of product categories, citing tariff-related cost pressures. This shows inflationary trends are already hitting the retail sector. If prices keep climbing, the Fed might have to keep interest rates high for longer, slowing growth and weakening the job market. Key 3. Interest rates. The Fed's dilemma. The Federal Reserve has been cautious about cutting rates, mainly to avoid stoking inflation. Monetary policy remains tight, and every Fed move is under a microscope. Moody's downgrade had another effect. It made investors demand higher returns to buy U.S. debt. This ripple effect increases the cost of borrowing for the U.S. Treasury. The more expensive it is to finance debt, the less funding is available for strategic sectors like healthcare, education, and infrastructure. What this means: loans become more expensive for businesses and households, discouraging spending and investment. Lower liquidity in the markets, leading to higher volatility and making it harder for the economy to recover sustainably. Key 4. The real economy. Life as it is. U.S. household debt has reached record levels, surpassing $18 trillion, according to the Federal Reserve. This weakens consumer spending, which drives over 70% of U.S. GDP. Even with unemployment steady at around 4%, real income growth hasn't kept up with recent inflation. In practical terms, many workers are earning less. Trump proposed tax cuts and infrastructure investment as short-term economic boosters. If passed, these measures could provide a temporary lift, but they're still under discussion and haven't been approved by Congress. And increased government spending would only add more pressure to the national debt, right when the credit rating has been downgraded. Strategies for investors. With so many moving parts, the big question is, what should investors do now? The answer depends on your risk profile, time horizon, and strategy. Passive strategy, ABB, always be buying. This approach is about consistently buying assets, regardless of market ups and downs. The goal is long-term growth, and the key is staying consistent. Example, investing monthly in ETFs like the S&P 500. Even during market dips, you accumulate more shares with the same investment amount, lowering your average cost. History shows that those who invest regularly in ETFs for 10+ years tend to outperform market timers. Time in the market beats timing the market. This strategy requires emotional discipline and a long-term mindset. Simple, but not easy. You have to stick with it even when it's tough. Active strategy, market shifts. Here, the focus is on spotting trends and taking dynamic positions. You look for sectors, regions, or assets benefiting from economic shifts. Example, if tariffs are reinstated, local manufacturing, domestic agriculture, and energy may benefit, creating short to mid-term opportunities. Also, market crashes can present great buying opportunities in high-quality assets. The classic buy when there's blood in the streets approach. But be careful. Active investing requires time, research, and risk management. Without the right preparation, you could end up speculating and making emotional decisions. Key reminders. Avoid emotional investing. Many people lose money by buying at the peak and selling during panic. Emotions are the biggest enemy of long-term returns. Diversification is essential. Don't put all your eggs in one basket. A well-diversified portfolio weathers storms and seizes global opportunities. Include assets like gold, international bonds, and global REITs to hedge against inflation, recession, and political instability. Consider strong currencies and well-positioned emerging markets. Spreading risk across regions increases resilience and potential gains. At the end of the day, it's not about predicting the future. It's about being prepared for it. A solid strategy helps you sleep better, even in turbulent times. The news that the recession has been called off might feel like a relief, but now's not the time to let your guard down. Tariffs, inflation, interest rates, and debt remain real challenges. The economy is like a game of chess. Winners are those who think several moves ahead. Remember, smart financial decisions aren't about perfect forecasts. They're about consistent strategy. Stay informed, diversify your investments, and keep your eyes on the long term. If you found this helpful, leave a like, share it with someone who needs to understand what's going on, and subscribe so you don't miss future videos. And remember, your financial freedom journey starts now. Click the link in the video description to download your free ebook, packed with investing insights, mindset shifts, and strategies to build lasting wealth.